आग से बचाए।
Welcome back. Well, in the next few minutes, we'll be getting the pre-open rates. But for the time being, let's welcome Chandan Taparia, who's joining to give us, his derivative strategies. Hi, Chandan. Morning.
Good morning, Nazal. Thanks for having me. So talking about market, the best is continuously shifting higher. We have noticed that in last couple of weeks, we have rallied well from 16,750 to all the way to 18,250 plus. And the good part is data setup is quite positive. The India VIX is continuously holding below 16 level. Put writing is holding well above 1. FI's long short ratio has increased. Momentum is clearly visible in many heavyweights counter, and good part is banking financial stocks already started to outperform. So I believe that with support base of 18,000, we are all set to head towards the new lifetime high of 18,500 to 18,600. So continue to be with long positions, buy on any decline, and use this momentum to play the upside tick of the market. Those who are looking for options can be with buying of 18,300 call, or can plan the bull call spread to continue to be with positive to range bound bias of the market. Looking at Bank Nifty index, that is going to hit the new lifetime high of 41,840 in the morning tick, and we believe that hold of 41,250 could take it towards 42,250 and 42,500 kind of level. So overall view is positive. If you are looking for the long term, then we are also expecting 8 to 10% uptick in the indices. Now looking at the stock wise on immediate trading point of view, most of the auto ancillary stocks are doing well, especially when I talk about the tire stock. We have seen good momentum in Balkrishna, Apollo Tire, JK Tire. So recommending to go long on Apollo Tire. This stock has given a consolidation breakout, even a bullish breakout from its pole and flat formations, adding long built up with put writing activity. So recommending to buy for an upside move towards 325. One can buy with a stop loss of 293. Apart from that, positive view on the Muthoot Finance. We have seen that gold is also giving the positive momentum, and Muthoot Finance has given a consolidation breakout of last 56 trading session. Yesterday also it rallied well, led by short covering and long built up, and we believe that momentum could continue for today as well. So one can buy with a stop loss of 1090 for upside move towards 1160. Last trading idea that I will play for the short covering from the metal space. Most of the metal stocks are in action. Jindal Steel is the recommendation we have here. This stock is continuously making higher highs, higher lows on the weekly space. So recommending to buy with a stop loss of 484, and here we have a target to us 525 levels.
All right, Chandan, thanks very much for that. Appreciate you joining in with those trading ideas. Anuj is here in the studios to run us through the setup as he sees it. Anuj, good morning.
Morning, Prashant. That channel or that trend line is back. I just want to focus on that Dow Jones trend line, and that's very important because yesterday, if you see intraday, the market actually collapsed quite a bit, and then in last hour had a miraculous recovery once again. So the reason I want to point that out is that the Dow Jones is at an inflection point. It had a massive rally in August and then had that big decline right from this channel. In fact, 3 times it's gone to that this trend line, falling trend line, and has gone down. So that way, yesterday's intraday move and the fact that the US election gets over today, so this pre-result rally, is this going to run into rough weather? I think that for me is the only risk factor in the market. Otherwise, of course, the market's pattern is very strong. The Indian market continues to outperform. And there's this daily pattern that we keep talking about. There's a gap up, profit taking through the day. And then at 3 p.m., there's again a move because you're pricing in for next day's gap up and rinse and repeat. This is what's happening. The dollar index is at 109.6 versus peak of 115, which is something which is really helping our market quite a bit. The Nifty very close to 52-week high and live high. 52-week high is 18,351. Live high is 18,604. I think if you open at 18,350, it's a simple trade to take your money off, step on the sidelines, wait for that decline, which the market gives you intraday, and then the zone perhaps to enter would be 18,250. If you get there, perhaps that's a good risk reward. And Nifty's base has now moved up to 18,050, which is a strict stop loss now for positional bulls. I think the Bank Nifty is very interesting because you opened today perhaps at a new all-time high. The all-time high is 41,840, which was what we did just last month. So we open above that. Maybe at 42,000, you do see some profit taking. But as I said, the one indicator I'll watch out for from here on is how the US market behaves after the elections.
Okay. All right. Thanks a lot for that, Anuj. Deven's still with us, I think. Deven, all right. I think we'll get to Deven in just... Okay. All right. Deven, I wanted to ask you about a couple of these tire companies. They've been doing very, very well. Cooling off of RM cost has been one tailwind that's worked out for them. How do you approach them from here on?
So, Nigel, I think forgetting the kind of a cost pressure that they've had in the past, probably the coming quarters and onwards, I think the price stability along with I think the cost pressure easing out is going to play out as a good thing for these companies. Along with, I think the particular in commercial vehicle segment and off-road vehicle segment, I think the tire companies are expected to show relatively better performance. I think given the kind of strength that they have in form of passing over the cost. So in my viewpoint, I think likes of Balkrishna, I think would probably be remaining relatively a better choice to buy into, given the fact that I think their significant amount of portion is also coming from off-road. And that's where probably I think the company could possibly show relatively better performance compared to other tire companies, which are I think more on a volatile side of the profit scenario. Otherwise, I think the entire auto space, particularly, I think looks very convincing. We are seeing the number of outstanding orders in the passenger vehicles which are being met in this 6 months. Commercial vehicle business, I think, is picking up very smartly, and even the two-wheeler business, I think, which up till now I think was I think languishing, has also started showing the traction. So believe that I think some of the tire companies would have I think relatively better time going forward as far as their profit outlook is concerned in subsequent quarters.
Okay, all right, Deven, thanks a lot for that. Well, for the time being, let's move on to our corporate that's standing by. Bajaj Electricals, well, they posted a weak set of numbers. High inflation, some stress in rural markets as well led to low offtake. That's what impacted their consumer product segment. Though the gross margins, they expanded, aided by the lighting solutions business. Mr. Anuj Podar, the MD and CEO of the company, joins us. Hi, Anuj. Morning. Thanks so much for joining in. Well, you have been talking about gaining market share. Now, I'm looking at your consumer products business. There's a small degrowth out there, so it's unlikely you gain market share out there. Could you tell us, what went on? Has there been any movement on the market share? And also, I don't think you're cutting prices big time. So then, could volumes get hit? In that case, again, you'll not gain market share. Give us some clarity on this front, Anuj.
So, firstly, let me address that straight on. We are gaining market share. And the important metric to look at is look at a 3-year CAGR. It's about a 14.3% for our consumer business. And, that's well ahead of average industry and well ahead of some of our peers. So there is a gain in market share. Number two, you have to remember, we are in a tough environment. Demand is soft. So some of that's baked into our numbers in terms of top line and revenue. But we've tried to hold on to our profits. If you look at on an aggregate basis as a company, we've delivered better PBT. Again, if I break that up into our segments, in fact, lighting is, I would say, the highlight for us this quarter. We've come back very strongly in lighting. We've been talking about that for a while, that we plan to grow and resurrect our lighting business. Our profitability on lighting has come out very strong this quarter. The EPC business, which used to be loss-making for a long while, again has delivered profits for us this quarter. Finally, the consumer business that you refer to, yes, there has been some decline in revenue and profits, but relative, I would say we've done a fairly good job on containing some of that decline in profits and margins. And some of that, I think, is a carry forward of the legacy high-cost inventory due to commodity inflation. We are very confident that Q3 onwards, you will see a reversal on the inventory cost, and therefore margins will bounce back from Q3 in consumer business too.
Hey, good morning. Has that high-cost inventory, where is that at? Is it mostly all run out? And so then what, because you indicated at the end of the first quarter also that margins will start to improve. It has at a EBITDA level. And you're guiding that they will improve more Q3 onwards. So if you can tell us, where is that high-cost inventory at, and what are margins going to look like 2-3 quarters out?
So that's correct. So firstly, if you look at sequentially, our margins are better off. If you look at Y on Y, they're slightly lesser, but you have to bake in the base effect on that one. The inventories are not 100% exhausted, but I would say a majority of that is exhausted. So you will see the uptake in the margins due to inventory, incremental inventory being at lower cost in Q3, and by Q4 it should fully normalize. So I think you will see a marginal uptake in margins in Q3 and a healthy uptake by Q4. We're very confident on that. And keep in mind that the lighting business also is now coming together and adding to the margin. So overall, on a company basis, our margins will continue enhancing from here fairly strongly. I'm confident about that.
Particularly for the consumer products business, the margins have fallen quite a bit. I mean, you used to do double-digit margins, 10% plus same time last year, and now it's about 7%. When you say it will get better, purely for the consumer products business, when do you think you can get back to double-digit margins?
So Sonia, firstly, I would defend ourselves saying if you look at the drop in margins Y on Y, it's the least versus competitors. You must keep that in mind. Secondly, the double digit, we've been guiding, we will expand our margins by 1 percentage point per annum. You must look at that on an annualized basis because we are investing for the future. So very clear on the roadmap for that. But without putting a specific projection, I think we should be able to beat that guidance over the next 2 years. Yeah.
Okay, all right. And Anuj is saying even this year you have gained market share. The 3-year story, I got it. You have gained market share. So even in this year, you're saying you've gained market share, right?
Yes, we have. Okay. And if you look at our rural versus urban shares, the mix is different versus competition. Rural is soft right now from a demand cycle, but if you split that up, actually we've gained market share in both of these markets. And the way it aggregates for us is slightly different versus competition.
For you, what is the split?
I'm sorry, I could not.
For you, what is the split of rural and urban?
But it's a very, very high double digit, almost 2x of other competition.
No, what is the split between rural and urban?
I'm sorry, your audio keeps phasing out.
From your perspective, Anuj, what is your mix between rural and urban?
Yeah, so my rural mix, we don't put out firm numbers, but it is a very, very high double digit, and that's almost 2x versus competition. So therefore, our weightage on rural is much higher. So the rural economy is weak. There is a slightly exaggerated impact on us, but I think we are only about 1 quarter away from rural markets coming back, and that should help us.
Right. Okay. Are you saying that your rural exposure is twice that of your other competitors? I mean, other players. So heavy dependence on rural. 2 questions. One, what gives you the confidence that markets will come back strongly? Because I mean, across sectors, across categories, companies have been telling us that rural and entry-level segments are suffering. They're faring poorly. So just some guidance would help.
So, we've been seeing that for the last 4 quarters, where it's a premium segment that is really firing for companies. And the, middle class or the rural segment is not doing so well. I do think, you should be at the cusp of turnaround on the rural. And I use some of the primary indicators of some of the FMCG companies, including the biscuit guys, etc. They're starting to see some traction from the commentary that I hear on the rural. The other interesting data that I saw yesterday or day before is the jobs data put out by CMIE. The jobs are finally back. I'm talking the organized sector salary jobs to about 32 months ago. That is pre-COVID levels. I think that's really good for middle class because that's the pure or core consuming category of people. So that comes in. I think it's not just a premium segment, but the middle mass segment which we cater to, that should come back in terms of demand.
All right, just one question that.
Yeah, all right. Anuj, very quickly, just wanted to squeeze in the demerger date. You had told us last time that it will be in the second half of this year. By quarter 3, quarter 4 should get done?
So we were hopeful to get quarter 3, but these are pending approvals from SEBI and NCLT. My best estimate at this point of time, it should happen by Feb or March.
Okay.
But the ball's very much in the court of the authorities. We are just simply awaiting approval. As soon as we have approval, it's an instant demerger.
Okay.
All right. Anuj, we'll leave it there. Thank you very much. Good luck. Appreciate you joining in with that perspective. Thanks very much. The pre-open is settled about 0.5% higher. 18,288 is where we are likely to start. But as we've seen for the last 3 or 4 sessions, it's not the start which really has mattered. It's the close because, I mean, after the start, there has usually been a dip, and at about 2:30, the market comes back strongly. Sudarshan, your 9-10 calls?
Well, buy the Nifty. If you have the Nifty, hold it. Otherwise, buy it on an intraday dip. You usually get these dips. Ramco Cement is a buy with a stop under 715.
Okay, Ramco is a buy under 715, 744 or so is where Ramco is at right now. So we've got what, 4 minutes to go actually for the market opening. Mitesh is with us as well. Mitesh, your 9-10 calls?
Yeah, I'll go with the buy on Apollo Tyres with a stop at 294 for a first target 315 and then 325.
Okay, well, the big mover this morning is Coal India. It's up almost about 2.5%. The numbers were looking good. In fact, Motilal Oswal has put out a report where they say that this is the highest ever EBITDA that we've seen for Coal India, and strong results. Consensus continues to upgrade. So let's see how it goes. For now, the target price that Motilal has is 325 rupees.
Higher than consensus, Sonia.
Motilal?
In that same note.
Okay.
They are higher than consensus. So okay. Motilal's positive on the stock, and clearly the dividend, I think, is something that the street likes, the 15 rupee dividend. But okay. Let's hop across to Abhishek. He's joining in to tell us about Paytm. Abhishek?
Talking about brokerages on Paytm, they say that FY23 revenues are in line and the EBITDA losses are now narrowing. So incrementally, the profit is being driven by lending business. So scale up is the key. The pre-IPO investor lock-in that opens up on November 15. So how that moves will be seen closely with respect to how much of the pre-IPO lock-in investors do come in for selling. Solid operational performance this time around for Q2 FY23, and the closure on IT audit that was directed by RBI, that will be seen closely. So Goldman Sachs says that they expect multiples to re-rate higher for Paytm, given the fact that it is approaching adjusted EBITDA break-even by mid of calendar year 2023. So across brokerages, you have a mixed view coming in with underperformance sell and underperformance rating from UBS, CLSA and Macquarie. Morgan Stanley has an equal weight rating, while Goldman Sachs and Citi have a buy rating. So across brokerages, the target price ranges from as low as 450 to as high as 1130 per share. Back to you.
Okay, very divided house over there. But let's go across to Sonal now and watch out for PI Industries. Sonal, over to you.
Well, strong set of numbers reported by PI Industries. It was a top-down beat, leading to a revenue growth of 31% on a YY basis. EBITDA was up 49%. Margins expanded 200 basis points at 24%. And profits were also up 46% for the company. It was driven both by their export and domestic markets, where exports grew 29%. And this is on a high base. Volume growth came in at 25%. 36% growth was seen in the domestic markets, which was led by 31% volume growth. The company says it was the new product launches that they made which led to this growth this time around. And they also said that trend of rising input costs and pass-through to the consumers continued in the first half as well. And EBITDA margins, they improved on account of favorable product mix and also operating leverage. They continue to have a surplus cash on their books to the tune of 2,300 crore rupees, and they continue to look out for inorganic opportunities, the buyout that they had been planning in the pharma space. And all in all, good set of numbers from the company and management commentary as well.
Okay, Sonal, thanks a lot for that. Just 30 seconds left for the markets to open. Looks like it's going to be a solid opening. Remember, the Bank Nifty will be hitting an all-time high this morning. 41,840 is the all-time high, and the Bank Nifty looks like it's going to surpass that. Coal India is your big mover, followed by Maruti Suzuki, where Suzuki has gone ahead and raised their sales forecast, so the stock likes that. And then you have names like Infosys, Asian Paints and Power Grid that are well in the green. All right, that's the first take on the index, which is up almost 75 points, so 18,276. A good opening, decent opening for the market, you'd have to say. The Bank Nifty is up almost 130 points, and there you have it. It's almost, okay, it's just about around that all-time high. Yes, a fresh all-time high on the Nifty Bank is what we've seen. 41,830 now, led by a lot of banks. So just look at the top winners. Kotak Mahindra Bank tops the charts, followed by IndusInd Bank. In the financials, you have SBI Life that's doing pretty well. So do keep an eye out on that. Coal India now up almost 3%, and volumes are also picking up on that one. On the downside, though, Divi's Labs reported weak numbers, so down about 1% there. ONGC is down about 0.3%. Hindalco is under pressure, down over 2%. Post the, we were just talking about that stock a while back, and HUL as well, down almost about 0.3%. Not a bad opening, you'd have to say. The Nifty now holding at 18,240. Remember, 18,351 is the 52-week high. So we're, just about 100 points away from that, virtually at fresh 52-week highs for the market. The Midcap index, though, is not moving with as much pace, but still a green tick is where we start.
Well, that's right, Sonia, and a few big reactions actually. MRF and CIAT, both of them are down 5.5% odd, so those earnings reactions not taken very favorably, both those two getting clobbered. You have Jubilant Food as well, that's opened up with a downtick of closer around 2.5% odd, so that's taken a bit of a knock. PI Industry as well, we had Sonal who told us earlier that those numbers were good. And that's reflecting in, the stock price as well. It's up closer around 5% odd, valuation-wise not cheap, but gives you a sense about how good those numbers are. Given that the stock is up close to around 5% or thereabouts. So the mid-cap index, there are a few stars in trade which are doing pretty well. PB Fintech as well, the stock is higher with a gain of close to around 4.5%. And Paytm, let's see what's the reaction we're getting on that one. As Abhishek told us, brokerages, they split down the middle. For the time being, it's up close to around 2%. The bigger challenge, though, for these companies will come in the next few days when that, the lock-in that was there for pre-IPO investors will open up. Indigo Paints, we're expecting a large trade to take place out there. I think that's taken place because that stock is down close to around 4.5 to 5% the last time I checked, 7% now. So it appears that 4.5% equity that we had alerted you about, that's happened. Prashant.
Nigel, so it's a solid start once again. The Bank Nifty hit a new high, and it's now about it's quickly given back about 200 points from the day's high. The day's high was 41,940, almost 41,940, and we're at about 41,770. So we'll see where this heads, but just took 0.19% left. So a new high, and then a bit of a pullback is what we are seeing. The Nifty's got 50 points now, and a lot of it for the last so many days is results reaction. I mean, some of the biggest gainers and losers for the last few sessions has been earnings impact. And I think today is no difference with Coal India, which is up 4.5%, as we pointed out. PI Industries, which is up 5%. There is Ujjivan Small Finance Bank, which is higher by 7%. It's got solid volumes. There is Policy Bazaar, which, by the way, reported a bit of an improvement. Policy Bazaar, of course, has been, even amongst the new age listed stocks, the worst performer. But that is coming up, reacting to a decent set, 5% higher on Policy Bazaar. There is Avanti Feed, which is up 7%. Specialty is restaurants, I guess, is up 8.5%. And there is Arvind Limited, which is up about 3.5%. Market breadth is almost 3:1 in favor of advances at this point. On the flip side, as we highlighted, Indigo Paints reacting to results on the opposite in the opposite direction is down 6% now, and Divi's Laboratories, which sort of saw a fair bit of cut, that's down another 2%. Again, I mean, numbers, of course, were poor for Divi's. Hindalco, Novelis numbers 2% lower. There is MRF, which is coming up with a 6% cut as well. So that's a very large sort of a volume take on MRF. You don't see that right there in the volume-led list, but it is today. And of course, Nigel highlighted Jubilant Food, which is lower. Lal Pathlabs, we spoke with a company just a while back. That's down. That's starting down 4% as well. 25.13 all on Lal Pathlabs at this point in time. Our market master of the day is Krishna Kumar Karva. He's Managing Director, MK Global. Mr. Karva, great to have you with us here. Thank you very much for your time. You know, the relative to other markets, what we hear is a great deal of optimism about how medium to longer term prospects are shining extremely bright. But what does one do about the near term? Hold on? Or do you think we are likely to run into a little bit of rough weather, largely because of valuations? Mr. Karva, your sense?
Good morning, and thank you for inviting me to the show. So yes, as you rightly said, the optimism is at very strong, and we are almost as an index level, we are almost near the 52-week high. And this is obviously a function of robust corporate performance and robust government policies, which augurs well for the coming 3-5 years also. Now, trying to time the market is very, very difficult. We have seen that despite $22 billion worth of selling by FPIs over the last 11-12 months, our indices are back to its peak. In June, we were something like 15,000 odd, 15,500. From there, we have recovered. So I would imagine that it's better that investors focus on bottoms-up investing and stay invested from a medium-term perspective. Yes, because of valuations or for short-term economic performance for companies, maybe here and there could be disappointing. But I think they should take that in their stride and continue to be invested. I think whenever we have tried to time the market and time, you normally tend to exit good quality stocks, and then it is very difficult to get back in. So there are massive tailwinds as far as the banking sector is concerned. So investors should continue to remain invested across sectors and in a very balanced fashion. No doubt the domestic economy seems to be doing very strong. So your banking sector continues to do well, and investors should stay invested. But even then, I would also look at looking at investing in the IT sector, where we have seen almost 25% kind of cut over the last 1 year. So investors with a medium-term perspective who are able to maybe digest some short-term pain should look to now investing from a medium-term perspective.
Okay, in fact, a lot of stocks are coming under some selling pressure now in the broader market, so don't lose sight of that. For MRF, the margins were under quite a bit of pressure this time. It was a 230 basis points fall in margins compared to what we saw last year at 8.2%. So MRF under quite a bit of pressure. Dr. Lal Path Labs, despite the management commentary, an optimistic commentary there, that stock is now down 4.5%. Suven Pharma, Metropolis Health are a couple of other stocks that are under quite a bit of pressure right now. And aviation stocks, Interglobe Aviation, down almost about 3% odd. Krishna, good morning and thanks for joining in. How do you approach the markets now in terms of individual sectors? Of course, banks have done very well, especially PSU banks. But do you think there's still some more legs over there? And where else do you see leadership emerge from?
See, I think, yeah, as I said, banking continues to remain robust, and from a next 2-year perspective, investors should at least get 15 to 20% compounded returns. But I think within that, if you look at your large private banks, if on a 1-year basis also have delivered almost like 15% returns. But it's the public sector banks which have delivered stellar returns of, say, almost 30 to 40%. And going forward also, whenever a sector is in tailwind, it is the tier 2, tier 3 participants who possibly will give superior returns. So aggressive investors should look to be investing in public sector banks or even tier 2, tier 3 private banks where possibly the returns could be much more stellar. Apart from that, obviously, your auto ancillary sector continues to do well. So I think that's a sector which is getting into a good cycle. So whether it's passenger vehicles, whether it's commercial vehicles and the tractors, all the 3 segments should give good returns to investors. So that's one segment. Overall, I think apart from the financial services sector, I think this the manufacturing sector per se, which is almost like 55% of the market cap. That sector from a 4 to 5 year perspective seems to be in a sweet spot. The various government schemes and the capex cycles picking up. So there I would classify companies right from auto ancillaries, engineering companies, specialty chemicals, pharmaceutical companies. This whole segment is in kind of a big run in the next 3 to 5 years. So that's one segment where you should be looking to further invest in.
Okay, hi Krishna, morning. For the past quarter, we have some of these earnings from cement companies which have been the best entry opportunity. Birla Corp today is down close to 5% in reaction to its numbers. Valuation-wise, that looks good. What's your view on the cement space? Do you believe that things will look up from here on?
So we believe that possibly in terms of earnings, this is the quarter where most of the cement companies have bottomed out in terms of pressure on costs, etc. And going forward, there should be an uptick in terms of their earnings per ton, EBITDA per ton, etc. So from a medium-term perspective, the sector offers good opportunities. Also, there should be a lot of M&A kind of activities where maybe you will see some of the smaller companies getting consolidated. So from a medium-term perspective, the cement sector offers good entry opportunities where stocks have corrected, I would say, around 25 to 30% over the last 6 months.
Mr. Kara, you mentioned PSU banks in the beginning. Historically, go back the last decade and a half, the rallies have usually fizzled, right? They've not been compounding wealth creators. Do you think this time it's going to be different? It's a very different space they are in now? Or one has to be cognizant to sell at the appropriate time as well?
See, I think there are 2 things. One is look at the quality of the balance sheet. I think in the last 3-4 years, whatever cleanup had to be done in the public sector banks has been done. In terms of provisions, etc., now their provision coverage ratios are at par with the private sector banks. So the balance sheets are very, very robust. And in an environment where now ability to raise deposits, that's going to be a key differentiator if you will be able to grow in the next 2-3 years. Public sector banks have a very strong franchise and they should be able to take a lead over some of the mid-level private banks as far as raising deposits. I think even the underwriting standards they have learnt and they seem to be at par with the private banks in terms of the underwriting standards. My sense is that yes, there will be a concern that public sector units per se should always be a trade because there can be some government interventions at some times. But today it's too early in the day to think about long-term what can happen to these banks in 5-year perspective. From the next 2-3 year perspective, valuations, entry levels is very attractive. and we should look to ride that. And then as you see the numbers, as you see the management actions, you can take a call whether to hold for a long term or whether we should exit at the right time.
Okay, what do you do with a space like autos? The trends on the top line are looking good, but there are still a lot of operational pressures that these companies are facing. Across the universe, is there something that you still like?
Yeah, as I said in the beginning, so passenger vehicle segment seems to be in a sweet spot, and it's the beginning of a cycle. And whatever commentaries you hear from the management, going forward, at least from the raw material perspective, the pressure should come off. That is the sense we get. So profitability should improve. And if it's not, I think you have to be very specific in terms of whether it's the passenger vehicle segment or whether it's the commercial vehicle or whether it's the two-wheeler segment. Companies which are focused on having the right product for the right segment of the market and having the right launches and have a decent exposure to electric vehicle segment or the hybrid segment, I think they will definitely get a thumbs up from the market, and they should be able to deliver superior returns. I think it's just the beginning of a cycle.
Okay, all right. Krishna, the other sector that's come back in style has been the metal space. It's anyone's guess what's going on in China, but for the time being, the street believes that there is some hope. There'll be a reopening out there. The dollar as well has cooled off. Would you think that, since some of these companies, their balance sheets are in far better shape than we've seen the last decade, would you invest, or would you say there are far better sectors to invest in?
I think it's a very volatile sector, but between the metals, if we have to differentiate, I think it's the ferrous metal sector where there are some government policy changes which impacted the working in the last few quarters. I think if they are reversed, then possibly the ferrous metal sector seems to be in a much better opportunity. I think the non-ferrous segment could be possibly more impacted by whatever is happening on the global front. So that is the way one should look to, I would trade in metal sector. I think that sector can never be an investment sector. But I would imagine that why look at a volatile sector when there are secular domestic trends which you can participate in.
So if you had to summarize all of this for us, Krishna, do you think that the market could stall before the next leg upwards? I mean, we're starting to see once again some risks emerge, whether it's higher commodity prices over the last 4 to 5 weeks, high valuations are a bit of a concern. So for the market as a whole, do you see this uptrend continue, or could we take a bit of a pause?
No, it's very difficult to say what can happen in the short term, but again, as I say that it's about thinking slightly longer term and look at the robust domestic inflows, look at the robust commentary from most companies in terms of their economic performance and prognosis going forward. I think things can only improve from here. Valuations are slightly expensive. And what happens if this, what we have seen, a negative outflow of $22 billion from FPIs in the last 10, 11 months, and if that changes for the positive, and there are talks that maybe some money which will move from China to India. Now, if that something like that happens, then it's not about the valuation, it is about the flows which will drive the market in the short term. So I would say that investors should not be worried about some sideways movement or price correction happening in the short term. Can it happen? Yes, definitely we should be prepared for it. So if you look at now also, wherever valuations have not been justified by the quarterly numbers, we have seen decent corrections in various large names and the mid-sized names. So I think market is behaving very, very rationally in terms of valuing companies, in terms of reacting to performances.
Okay, all right, Krishna, thanks so much for stopping by and giving us your views on the markets as well as the whole host of sectors that we discussed. Wishing you a good day ahead. Well, let's focus on Birla Corp. Well, that posted a weak set of numbers. The stock is down close to around 5%. Input costs spiked up, and clearly they have been struggling because the newly commissioned Mukutpan cement plant that continues to drag the overall performance. We're joined by Mr. Aditya Sirogi, the CFO of the company, who joins in. Hi, Mr. Sirogi. Good morning. Thanks so much for joining in. Well, let's start off with Mukutpan, the unit itself. That's dragging the EBITDA per ton and the operational performance as well. When do you expect this unit to turn around? I think for this year, you're guiding around 1 million tons of sales. For FY24, what kind of a ramp-up can we see in this unit?
In this year, as we have said, we are expecting about 1 million ton. Next year, we should be doing more than 2 million ton. And as we have already said, from next year, we'll start getting the incentive of more than 600 rupees a ton, which will go a long way in improving the profitability of the unit. Also, the various wastage recovery will be commissioned at the end of December, so that will bring down the cost further.
Okay. So that seems to be the big problem, right? Costs, because you've had a sharp surge in power and fuel costs. Your other expenses have gone up significantly. Can you tell us what is the expectation for the second half of the year? Will you continue to see this low single-digit margins? I mean, it's not even 5% in the quarter gone by. So what can we expect in the second half?
See, in the second half, margin should be much better than what we have done in the first half, because in terms of both the fuel rate as well as the realizations, we are behind the peak and the bottom respectively, which we had witnessed in the second quarter. So going ahead, we see some moderation in the fuel rates and improvement in the realization. On the both the accounts, we should be doing better in the remaining part of the year.
Okay, all right. Mr. Sarogi, give us a sense about cement price increases. Now, we have heard that in select parts of the country, there have been price increases. So, if you could tell us, what is the price, the average price in quarter 3, and if you could compare it with the average price of quarter 2. Then I'll come back with my next question.
Yeah, so the price increases have been in the range of 5 rupees to 10 rupees. In center and north, I believe it is 5 rupees, and east and west, it has been 10 rupees.
All right, so that is the price increase on an average for this quarter versus last quarter, right? 10 rupees, 5 to 10 rupees a bag. The other part the street will focus on is then on cost side. How much of cooling off on a cost per ton will we see, say in quarter 3? And I think bulk of the cooling off will happen in quarter 4. We're going as per current prices. So according to your analysis, what is it?
See, we have seen a peak of petcoke prices of about $250. From there, it had come down to as low as 165. It has again inched up and stabilized around $190 currently. And we see broadly in the range of, let's say, $175 to $190 should be the range for fuel prices.
Okay.
So if at these levels, I would expect the cost benefit on account of fuel to be in the range of 50 to 100 rupees a ton.
50 to 100 rupees per ton for quarter 3. So they'll cool off by 50.
Not immediately in quarter 4 only because of opening stock and all.
No, Mr. Sarogi, apologies to come in at this point, but I'm just wanting to understand what will be the cost per ton cooling off in quarter 3 and how much of it will it be in quarter 4? If you could give us a number, 100 rupees per ton, 200 rupees per ton, all costs put together.
In quarter 3, I would say it should be around 50 rupees and quarter 4 around 100 rupees.
Okay. Tell us a little bit about how the demand is on ground. I mean, are you seeing a big pickup as far as demand is concerned? If yes, from which pockets? And I think you had a 15% volume guidance for the full year for FY23. Would you stick to that?
In terms of demand, October has not been that great because of festivities all across. But we do expect the demand to improve in the coming weeks and months. And yes, we are sticking by our guidance of 15% growth for this year.
Okay, all right. So what about the EBITDA per ton range, sir? Keeping in mind that Mukutman is going to be dragging for the next couple of quarters, what is the guidance that you could give us on the EBITDA per ton? If you want to include the unit or X of that unit as well, give us a broad number going by the price increases and cost cooling off.
See, as I said, our EBITDA per ton should definitely be better than what we have done in the first half. For the second half, in the previous year, we had done around 650 rupees a ton. With Mukutman, we should be doing around those numbers.
Okay.
At this juncture, that is the expectation we have. But a lot will depend on the market conditions as well.
So there is a lot of capex that you have put on board in Mukut in terms of spends as well, right? The understanding is that perhaps over 300 crores was spent there. What does this mean for your debt situation? I think you have around over 4,100 crores of debt. Do you plan to bring it down in any way? And if yes, what could the debt be, say, 1 year hence?
I would say that we have seen the peak of our debt. 4173 should be our peak debt. From here on, it should reduce only. I can't give you a definite number. Maybe in the next quarter, I can give you a sense of what it should be in the next year.
Okay, all right. But debt has peaked out. That's good news. And also, just to confirm, sir, the EBITDA per ton, including Mukut will be around 650 rupees, right? That's what you're expecting for the second half.
Yeah, that's what we're expecting.
Taking into account Mukut.
Yeah.
Okay, final question then. There's so much of talk about inorganic growth. Are you all looking at any asset? You'll have that ambition for 20 to 30 million tons, and you've been mentioning that will be organically. But have you looked at a couple of units? Say the India Cements Rajasthan unit, which reportedly is on the block. We have no confirmation about that. Have you looked at it?
No, we have not. As we just discussed, our debt is on the higher side, so we would rather like to bring it down rather than taking further leverage.
All right, we will leave it at that. Thanks a lot for joining in and all the best. That's Birla Corp saying that in the second half of the year, the margins will be definitely better than the first half. First half was very weak in terms of margins for them, and the Mukut plant is definitely weighing on the EBITDA performance. But they're saying that things will improve, and this is the peak debt that we're seeing for the business, which is, of course, a positive thing. By the way, big moves coming in the market in terms of individual stocks. Coal India is now up over 4% and big volumes on Coal India. So do keep an eye out on that. And on the downside, Divi's Labs is the one that's taking a knock. So 3% lower on Divi's Labs, and MRF down almost about 6% multi-quarter lows for the margins.
Absolutely. Sonia, so many, these lesser discussed stocks coming up, jumping up, even as the index is not doing much. So you look at Rushil Decor, which is up 10%. Axis Cades is up 4%. KRBL is coming up with about a 4% pop. I mentioned Ujjivan Small Finance Bank, which is up another 6% or so. There is Union Bank, which is about 6.5% higher. The Nifty PSU Bank Index, by the way, is up almost 1%. Phoenix Limited is starting about 4% higher. There is Honda Power, 16% pop. Again, lesser discussed, but 21-22 on that one. Care Ratings is up about 8.5%. So there is a lot going on in the small cap slash mid cap space, part of the market, which is doing very, very well. 20 points for now on the Nifty. So far it's playing out like what we saw on Monday and Friday, which is a very strong start. The market cooling off, doing nothing for the rest of the day. The last act has to play out, which is, of course, a pop in the last hour of trade, which has happened last two sessions. We'll take a break here. We have the management of Godrej Consumer Products, Samir Shah, joining us to discuss Q2 earnings and a bit of outlook going forward. We'll also have the management of Bosch joining us on the other side, Soumitra Bhattacharya of Bosch, to talk about their earnings. Stay tuned.